Thank you for tuning in, and also thank you for AJ Bell for giving me the opportunity to share some thoughts with you. So I'm going to spend a bit of time today, although I caught a bit of Bruce's presentation earlier, and I think he may have paved the way for me quite nicely in terms of talking about Asia and emerging markets, but obviously I'm talking more about Asia here. And from an income standpoint, we think Asia is well positioned. So I'm going to talk about that. I'm going to talk a little bit about the response from COVID, why Asia's done a lot better than elsewhere, what that means for earnings, dividends, GDP in the coming years, and most importantly, obviously for this seminar, talking about income, and for a lot of our investors who are retail and income orientated, what that means for dividends as well, and then a little bit about Henderson Far East. So without further ado, perfect. Okay, well let's talk a little bit about COVID. And this is just a slide which I'm sure you've seen before, but this is a slide just talking about the history of infections, the 7-day averages. And although this is a little old, going back to the middle of November, the trends are pretty clear. And we may have seen a deterioration in the US and a slight deterioration in Europe and a bit of improvement in the UK. But on the whole, these are the trends we've seen. Now, what we have on here is 2 lines for Asia. One's Asia ex Japan, and the other one's Asia ex Japan and ex India. And the reason why we have 2 lines on here is mainly because about 85% of the cases in Asia Pacific ex Japan were actually in India. So the dark blue line on here, which is peaking, and the highest line kind of in the August September, was really an impact of India, and to a lesser extent Indonesia and the Philippines, which are the 3 countries most affected by COVID. Whereas you look at the grey line, which is the one second from the bottom, if the colours aren't that clear to you, and to be honest, for a continent of nigh on 3 billion or over 3 billion people, to have the number of cases on an ongoing basis that Asia had was incredibly low. And there's a few reasons for this, I think. Firstly, I think you have to think about the demographics. Asia generally has a lot lower population, so although that doesn't necessarily affect the number of cases, it certainly affected the number of deaths. The second point is weather. Generally Asia is hotter, a lot of it's tropical, and we do know that the disease doesn't work quite so well in warm temperatures as it does in cold, but by far the most important was the fact that Asia has history in diseases. And for someone who's covered Asia for 30-odd years, I've seen SARS and bird flu and swine flu and various other flus across Asia. And every time you go, you tend to find airports and around the streets, etc., people wearing masks. So the whole idea of wearing masks and protecting yourself in the face of a kind of virus or pandemic is very commonplace. And you also get the feeling that the people tend to have more, or tend to adhere to government advice more so than we do in the West. So I think the population are used to it, they're scared of it, and as a result, the reaction and the impact to the general population was a lot lower. I also think that generally Asian governments handled it far more aggressively and much better than we saw here in the West, and certainly in the UK. So COVID impact from a health perspective, it's been pretty minimal, but it's actually from a wealth perspective as well. So this just looks at the earnings, dividends, and GDP growth in 2019, 2020, and 2021 for Asia, US, Europe, and UK. And it's pretty obvious from this that actually the crisis, which has been brought on by the pandemic, although it originated in Asia, to be honest, is a mere blip from an Asian perspective. The GFC was far more significant than COVID-19 is in terms of any of these 3 metrics. So for GDP growth, we expect this year that Asia will probably only fall by 1%. China, which I know some people are quite sensitive about the fact that the pandemic originated in China, and China is actually going to probably be one of the only economies in the world this year that grows. We expect that to grow by roughly 2%. So the impact has been pretty minimal. Dividend growth in Asia fell by 5%, probably picks up by 10 to 15% next year, and earnings hardly any impact at all. Yet we're still expecting 25% earnings growth next year. These are consensus numbers, not our numbers. And the numbers you probably have to call into question here is the UK, Europe, and the US, because it's far from clear when the impact from the pandemic ends. You could argue that the second wave, maybe there's a third wave, I don't know, but currently we're still in the heart of the second wave, although there is the vaccine does give us a light at the end of the tunnel. But these numbers are predicting big declines followed by big rises. Now, you know, if we're still in lockdown in the middle of the year in somewhere or another, these expectations of earnings growth in the 35 to 40% range are going to be quite way off. So the point I'm trying to make here is that Asia has been less impacted by COVID, both from a corporate and a growth perspective, an economic growth perspective. And the numbers that are being forecast, I think you probably have a lot more reason to be confident about these numbers going forward than you have about the expectations of other places around the world. And once we start talking about big percentages, I think sometimes we lose a bit of perspective. So this is just looking at nominal GDP, but again, those 4 regions. And it's pretty obvious when you look at that in the dark blue line for GDP on the left-hand side that really 2020 is a small blip, and we'll look at it in 10 years' time and probably hardly notice it. But it's pretty safe to say that GDP will be higher in 2021 than it was in 2019, and much harder to say that for the rest of the world. In fact, it's highly unlikely that the UK will go back to the levels pre-COVID, probably until 2023, maybe even later. The US and Europe maybe slightly sooner, certainly the US. But even so, this is a significant impact on the wealth of the economies of those Western markets. And corporate profitability, again, the same. A very small blip. It's just really a move sideways in terms of corporate profitability for Asia. And again, 2021 will be a better year than 2019. Whereas again, Europe and the UK probably expected to have similar kind of numbers, but to be honest, it's probably a bit finger in the wind and a flip of a coin as to whether corporate profitability next year reaches the same levels as it did pre-COVID. So that's the first point of the presentation, just giving you some idea of where we are now and how Asia's reacted to COVID and come out the other side. To be honest, you know, a lot of economies now are closing in pretty close to normality, especially China, but and North Asia more than South Asia. But even so, it looks like the worst of the pandemic is being contained, and the region is moving on. Which allows us to go back to the opportunity that Asia presents, which is a huge impact on the trends, the global trends going forward. So I put a few highlights here, and some of these pictures have been taken out of the Henderson Far East annual report and accounts. There's more in there if you want to have a look. But there's some really important numbers here. You know, 50%, more than 50% of the world's consumption growth in the next decade will come out of Asia. So if you're buying consumer stocks and, you know, the fact that people earn more over time and spend more over time, over half of the world's consumption growth will come out of Asia. And by 2040, around 40% of the total consumption will be in Asia, which is a chart on the next slide. There is obviously some issues, there's some risks. Clearly, as China in particular becomes more significant and gets closer and closer to the US in terms of size, that the US is going to hit back, and we've seen that already, and it's probably likely to continue. But you know, it's not a massive assumption to say that China will be bigger than the US by 2030. In fact, all we need is 3% superior GDP growth over the next 10 years per annum for China to exceed the US in terms of size. And within China itself, China will have more people over 60 than the entire population of the US. At this point, they will be incredibly wealthy. They will have very high levels of savings, and that's the part of the population that's driving this consumption growth trend. And there's some other charts on here just saying that 66% of the world's middle class will be in Asia in 10 years' time. Phenomenal numbers, phenomenal opportunities. I've got a few more slides on this, but for the sake of time, I won't go into that. I'm sure AJ Bell can send you copies of the slides afterwards if you wanted to look more. But what I'm trying to say here, there's a massive opportunity, and COVID hasn't derailed that opportunity. So what about valuations? Well, I think Bruce showed a slide of some of the valuations which look pretty scary for equity markets in general. And to be honest, I'm not going to stand up here and tell you that Asia's cheap. Because on the chart on the left-hand side here, price to earnings at 16 times is well above the longer-term averages in terms of PE. But that's somewhat distorted by some of these technology names, healthcare names, which have done so well, but trade on very high multiples. There's a lot of Asia which is trading at very fair valuation. What does look more appealing is Asia compared to the rest of the world. Now, obviously, the other markets have gone up, and actually their re-ratings have been far more significant, mainly being as the price has gone up by just as much, but earnings haven't. So you've had a bigger re-rating in the US in particular, but in other markets compared to Asia, which is why when you look at Asia relative to the rest of the world, Asia still looks pretty cheap. So yes, there's reasons to be nervous about equity valuations, but on a relative basis, Asia looks better. And if you start stripping out some of these high-value internet, tech, electric vehicle names, then the market looks much more reasonable. And it's those are the stocks of the areas which we play in. We don't play in the internet areas either because valuation and yield prohibits that, or lack of yield prohibits that. So let me talk a little bit about dividend yield. So dividends haven't been impacted this year. There were companies that cut dividends. Some of them didn't need to, but did anyway, just to be prudent. Obviously, we don't particularly like that as income investors, but we know it happens. But dividends are being paid off a very strong base. Net debt to equity in Asia is incredibly low. So we've seen some trends. I think, again, Bruce showed a chart earlier of some of the levels of corporate debt which have risen around the world. In Asia, that hasn't been the case. Companies haven't geared up, mainly because they haven't needed to. And capital expenditure has been constrained, as you can see on the top right-hand chart here. Asia used to spend huge amounts in growing its presence globally, but now doesn't. And what's really important here, of course, is cash flow. Because as an income investor, what pays my dividends is cash, ultimately, rather than earnings. So companies that continue to generate excess levels of cash will ultimately pay higher dividends over time. So the basis is very strong. Low levels of debt, low levels of investment, high generation of cash. And the most important point of all is that Asia pays out a much lower percentage of its earnings as dividends than the rest of the world. So the payout ratio, the dividend payout ratio, the percentage of dividends paid out of earnings is around about 35%. That's way north of 50 in most of the developed world. And that's important for two reasons. As we found out, dividends get cut in the Western world when earnings get hit. And the reason being is you don't have much of a gap between earnings and dividends. If earnings get cut, then ultimately dividends must do as well, unless they're funded out of debt. But if we have that big gap, then if earnings get impacted, then there's less need to cut dividends. But also, conversely, in better times, it also gives you more potential for dividend growth, because you don't necessarily need to see earnings per share growth, but I believe, that payout ratios will rise over time and rise up to the levels that we see in the Western world. So you don't even need to see earnings growth in Asia to get dividend growth as payout ratios rise over time. This is another chart about dividends, and the important thing about this is people will show this and say, well, weren't the dividends in in Asia hit pretty hard. If you look on the left-hand side, the percentage of companies cutting dividends, and actually it looks like around 40% or just over 40% cut dividends. Well, they did, you're right, but the degree of the cuts was far less than elsewhere. And that's shown up on the chart on the right-hand side, which just looks at the global financial crisis and looks at what happens to dividends for different regions around the world post the global financial crisis. And the red bar is the percentage of companies that cut dividends that never actually recovered, which in the US is quite incredible. So 45% of companies cut dividends, who cut dividends have never actually recovered those dividends to those previous levels. That's partly because there's a buyback culture rather than a dividend culture in the US. But the world index, 25% of companies post GFC have never returned to that level. And on average, it takes about 3 years for the dividends to recover to previous levels. Now in Asia, post the GFC, it was a lot less than that, about 2 years to recover. And I would argue this time, considering the impact from COVID is far less in Asia than it is elsewhere, that actually we're going to see recovery back to pre-pandemic levels of dividend within 1 year. Whereas the rest of the world may see 2 to 3 times that in terms of longevity, in terms of dividends back to pre-crisis levels. There's another chart looking at the history of how sustainable dividends are in the region. And it obviously includes the GFC, where if you look there, so the red bars are the percentage of companies that increase dividends, the ones that dark blue is cut, and the orange is dividends that are held steady. So back in 2008, 45% of companies cut dividends, and that compares with this year about 41%, as I showed you on the previous chart. But what is important here is that actually at the same time as we are seeing 41% of companies cut dividends, this year we saw 38% of companies raise dividends. So as an income investor, and you pick and choose your areas, you know which sectors are susceptible to dividend cuts, and there's still opportunity out there to pick up dividend growers, even in the markets we've seen like this year. I know I'm running out of time, so I will skip a couple of charts here, but just the one point on this chart is, and this is a little unfair to the UK. The market has had the biggest dividend cuts, but what I wanted to point out here was the fact that the revenue stream for Asia is a lot more diverse for an income investor. So in the UK, there's a lot of concentration. In 2019, 42% of dividends came from 5 stocks, where in Asia Pac, ex-Japan, 10 stocks only accounted for 37%. And this just shows you the distribution of income between sector and country. So lots of different sectors, lots of different currencies, lots of different countries. So much more diverse income stream. And this is quite an important slide, because this year's been a struggle for income investors. As we know, growth has been to the fore, and the internet names, healthcare, electric vehicles, these kind of areas have really shone, and it's been a struggle. And this is a chart which it's a little old now, but to be honest, the trends haven't changed that much. But what it shows is the history for the income investor over the last 18 years. And what it shows is the valuation of the highest 25% yielding stocks in each market, and how that valuation compares to the market as a whole. So Asia ex-Japan here is the grey, and obviously you can see the other regions. What this does show you is that yield in Asia for that top 25% of yielding stocks has never been cheaper. And what I can say to you, of course, is that what happened to dividend yield after 2012, when we had anemic growth following the GFC, and everyone wanted yield in a falling interest rate environment. At that point, those highest yielding stocks went to a premium to the market. We currently sit at a 50% discount. So if it plays out in the next few years in the same way as it played out post the GFC, a period of anemic economic growth, accompanied by a period of really low interest rates, excess liquidity, government and central bank intervention, then yield looks incredibly cheap at this level. So finally, just a couple of things on Henderson Far East. It is a total return strategy, although clearly this year income's worked a whole lot better for us than capital return. Capital performance has been poor, and I'll hold my hand up to that, mainly because, as you saw in the previous chart, yield has been such a bad performer. We do have the highest yield in the sector. The yield currently is just north of 7%. But what is important is that dividend this year was backed by revenue. So we didn't dip in the reserves, the dividend was covered. And we increased the dividend in the middle of the year by about 2%. We've been issuing shares. I'm fortunate to do so. We've been trading at a premium. So although, again, this gives me confidence again about where markets may go, is that although our capital performance hasn't been that great, our level of yield has still been well supported by our investors, which goes to show, I think, that ultimately nothing's changed. The market's got excited about the internet, excited about e-commerce and various other things. But what it really comes down to is the world has an aging population, and this is a low interest rate environment and likely to be so for some time. So the need for yield is intense, and that's what keeps us as a premium. Finally, what do you get with the portfolio? Well, we have a barbell approach really of dividend yield and dividend growth. So the high yield names are in the stable cash flow generating companies you'd expect, kind of property, some financials, although we don't like banks at this point, telecoms, these kind of areas. And then we have dividend growth, which gives you exposure to some of those trends I talked about. So, you know, consumptions, autos, healthcare, tourism, etc., etc. And we have exposure in the dividend growth part of the portfolio, but we're very much focused on value. So you can see that the broad index is at 16 times and it looks expensive, whereas the portfolio is on about 12 times earnings. But we don't give up quality for that. Return on equity, which is the measure of profitability, is very attractive, both especially compared to the broad index, considering the level of discount. So I will leave it there, and thank you very much, and hopefully answer your questions in the panel that's likely to follow.